Stop watching the silver price. Start watching the metal. Right now, not last week, not some forecast, China is paying $16 to $18 more per ounce than the United States. Shanghai silver is trading near $128. Comex is just over $110. That's not a spread. That's a fracture. And while that gap widens, Comex inventories are draining fast. Nearly 1 million ounces walked out the door in a single day. If you're holding silver, watching silver, or even ignoring silver, this matters. Because what you're seeing isn't a price spike. It's a structural warning. Price lies when paper markets dominate. Physical premiums don't. If you're watching this now, you're early. Most people won't notice until the shelves are empty. We're not here to predict prices. We're here to teach you patterns you'll recognize again in silver, copper, energy, food. Your job is to understand the structure. Before we go further, hit subscribe. Not for growth, for survival. We don't front-run headlines here. We watch pressure, and pressure is building. Drop a comment. Are you watching price or availability? Now let's break this down. Shanghai premiums are expanding. Normally, physical silver trades $2 to $5 above futures. Stress shows up around $15. We're past that, way past that. Comex eligible inventories? Draining. The registered category, metal actually available for delivery, is under constant withdrawal stress. And the pace isn't incremental anymore. It's sudden, 500,000 to 1 million ounces in a day. That's not noise. Here's what most people miss. This isn't China being overpriced. It's the West being undersignaled. Futures markets price, optional delivery. You can roll, you can settle in cash, you can wait. Physical markets price, immediate necessity. You need it now, you pay now, you take it now. When metal moves, price follows, not the other way around. Think about that. The chart you're staring at, it's pricing contracts. The premium you're not watching, that's pricing reality. Let me name this simply. Paper-physical decoupling. It's when futures stay calm while real metal reprices violently. Two valves on the same pipe, one controlled by contracts, one controlled by trucks and warehouses. Here's how it works. Paper markets absorb stress with leverage. Someone wants exposure to silver? Sell them a contract. No metal changes hands. Position grows. Market stays liquid. Price absorbs the flow. Physical markets absorb stress with rationing. Someone wants actual silver? You need inventory. You need transport. You need settlement now. When demand is real and immediate, paper becomes irrelevant. And right now, China's industrial demand doesn't wait for roll dates. It pulls metal now. So while Comex shows orderly trading, Shanghai is paying triple-digit silver. That's not inefficiency. That's necessity. This pattern repeats. It happened in nickel. It happened in energy. It happened in fertilizer. Same shape. Different commodity. The futures market says, we can handle this. The physical market says, we're out. And here's the part that shakes people. The most dangerous moment is when price looks calm. Because calm price with draining inventory doesn't mean everything's fine. It means the pressure hasn't surfaced yet. It's building underneath. In lease rates, no one tracks. In delivery times, stretching from days to weeks. In premiums widening in markets most people don't watch. You see green candles and assume strength. You miss the warehouse going empty. Not telling you to panic, showing you what decoupling looks like before it breaks headlines. Circle this. Futures absorb stress. Physical reveals it. The Comex can roll positions forever. Shanghai can't roll truckloads. And when that gap widens far enough, when the paper price and the physical price stop pretending they're connected, one of two things happens. Either supply floods back in and premiums compress, or the paper market loses credibility and the physical market sets the price. We're watching to see which. Your job isn't to predict the outcome, it's to recognize the setup. Now layer this in. Before price explodes, access disappears. Rationing comes before repricing. Most people think a squeeze looks like a vertical chart. Maybe, eventually. But first, it looks like delays. It looks like premiums creeping higher. It looks like dealers saying, we can get it, but it'll take 3 weeks instead of 3 days. Metal disappears first. Price resets later. Why? Because the entities moving large size don't lose money first. They lose control first. Imagine you're a bullion bank. You got obligations. Futures you sold. Swaps you wrote. Lease agreements tied to inventory you thought would stay put. And then someone starts pulling metal. Not a little, a lot. Consistently. You don't blow up your P&L immediately by spiking the price. You ration. You slow walk delivery. You tighten terms. You hope the pressure eases. But if it doesn't, if Shanghai keeps paying up and Comex keeps draining at the same time, then the banks face a choice. Deliver metal they don't have, or settle in cash and admit the contract isn't real. Not saying that's happening today, showing you the mechanics so you know what stress looks like before it's obvious. Right now, withdrawal size is the tell. Incremental, normal market function, sudden 500,000 to 1 million ounce hits. That's positional. That's someone who needs metal and doesn't care about the optics. Forward curves matter too. Normally, silver futures trade in contango. Deferred months cost more. That's the carry, storage, financing, time. But when the curve flattens or worse, inverts, that's the market saying metal today is worth more than metal tomorrow. That's scarcity pricing in. Dealer availability is another layer. Call around. Ask for delivery. How long? What premium? Any limits on size? When you hear, we can do 10,000 ounces, but anything above that, we'll need 2 weeks, and the premium goes up. That's rationing language. They're not out. They're managing flow. And managing flow is what you do when you're not sure the next truckload is coming. We saw this in palladium. We saw it in rhodium. We've seen it in energy markets when pipelines choke or refining capacity tightens. The price doesn't tell the story until the story's over. By the time the chart screams, the informed money already moved. Think about that. If this breaks, it won't break on a chart. It'll break in a warehouse, in a delivery failure, in a cash settlement that wasn't supposed to happen. And then the chart will react. Here's what you need to sit with. You're watching two markets pretend they're one. On one side, futures contracts, cash settlement, leverage, roll dates. On the other side, trucks, vaults, refiners, immediate demand. As long as most participants stay in the paper market, the system works, liquidity flows, positions net out, everyone's happy. But what happens when a big buyer, say an entire industrial economy, decides paper isn't good enough? What happens when they say, we don't want exposure, we want metal? The futures market can absorb that appetite with contracts. Easy. The physical market has to deliver actual silver, harder. And if Shanghai keeps paying $16 to $18 over Comex and eligible inventories keep shrinking, we're going to find out which market actually sets the price. Is it the one with the leverage or the one with the trucks? I don't know the answer yet, But I know the question matters because if the physical market wins this round, if premiums stay elevated and inventories don't stabilize, the paper market either delivers or it breaks. And breaking doesn't mean chaos. It means forced cash settlements. It means narrative shift. It means the confidence that you can always get metal at spot evaporates could reverse tomorrow. Premiums could compress. Inventories could refill. Shanghai could back off. But right now, the pressure is building and the calm chart is the loudest warning. Let's map the scenarios. In the first path, pressure releases. Shanghai premiums compress back toward $5. Comex inventories stabilize or refill. Forward curves return to normal contango. Delivery times drop back to days. This happens if Chinese demand softens, new supply hits the market, or speculative positioning unwinds and frees up metal. Paper market participants win. Short volatility strategies win. Anyone waiting to buy on a dip wins. Anyone who panic bought at the peak premium loses. In the second path, it's a slow grind. Premiums persist in the $10 to $15 range. Metal keeps leaking out of Comex, but not catastrophically. Delivery times stay extended. Nobody blows up, but nobody's comfortable. This happens if demand stays elevated but not urgent. Inventories drift lower without crisis, and the system manages flow without breaking. Patient accumulators win. Anyone with metal already in hand wins. Dealers managing spreads win. Momentum chasers expecting an immediate breakout lose. Anyone short and hoping for quick relief loses. In the third path, it snaps. Premiums spike above $20. Comex inventories drop below critical thresholds. Delivery failures surface. Cash settlements replace physical delivery. Narrative flips hard. This happens if Shanghai doesn't back off. A major holder demands delivery or inventories hit a point where the system can't meet obligations. Early physical holders win. Anyone who recognized the setup before the move wins. Leveraged paper longs who didn't take delivery lose. Shorts caught on the wrong side of a squeeze lose. Anyone assuming liquidity would always be there loses. Not predicting which path. Showing you what to watch so you recognize the shift when it comes. Here's what I'm tracking this week, this month. Shanghai silver premium. Normal is $2 to $5 over Comex. Stress is 15 plus and widening. Current is mid to high teens. What it means is if premiums compress, demand is easing. If they hold or widen, the fracture persists. Comex eligible versus registered drift. Normal is stable levels, incremental movement. Stress is fast. Large withdrawals, especially from registered deliverable metal. What it means is watch the pace. 100,000 ounces? Routine? 500,000 to 1 million? Positional stress. Daily withdrawal size? Normal is incremental, scattered across participants. Stress is sudden lumps. Single-day hits that stand out. What it means is size plus frequency equals urgency. Someone's not waiting. Forward curve shape. Normal is contango. Deferred months cost more. Stress is flattening or inversion. Spot greater than forward. What it means is inversion says metal now beats metal later. That's scarcity. Dealer availability and delivery times. Normal is days. Standard premiums, no size limits. Stress is weeks. Escalating premiums, rationing language, above a certain number of ounces call us. What it means is dealers manage flow when they're unsure of resupply. Listen for hesitation. If you're a trader, respect volatility. Position size matters more than conviction. Can't know timing, only structure. If you're a stacker, accept pullbacks. Physical takes time. If premiums spike and you're late, you overpay. If you're watching from the sidelines, understand this isn't just about silver. It's about how physical and paper markets interact under stress. Learn it here. Recognize it everywhere. Risk clusters I think about, not advice, just awareness. Diversification across asset types. Don't be all in on one thesis. Liquidity. Know what you can sell and when. Delivery optionality. Paper's great until it's not. Physical is clunky until it's essential. Jurisdictional spread. Different markets, different rules, different stress points. Time frame honesty. Are you trading a week or holding a decade? Strategy changes, counterparty risk. Who's on the other side of your trade? Can they deliver? Your job is to understand, not to predict. If you watch flows instead of headlines, you put yourself in the group that sees breaks before they trend. You don't need to be perfect. You need to be aware. The people who got hurt in past squeezes, they ignored the signals. They assumed liquidity was infinite. They trusted the calm chart over the screaming premium. Don't be that person. Watch the metal. Watch the withdrawals. Watch the premiums. Watch the delivery times. And when those signals cluster, when multiple indicators flash stress at the same time, you'll know something's shifting, not predicting prices, not telling you to buy or sell, showing you what pattern recognition looks like in real time. Because silver isn't the story, structure is, and structure always moves first. Drop a comment. What's one signal that changed your mind before the crowd noticed? If this helped, hit subscribe. We're building a group that doesn't get shaken when markets move because we saw it coming. Links to Comex inventory reports and Shanghai premium trackers are in the description. Stay sharp.